Let's get some reasoning and bring in Bilal Hafeez, Macro Hive CEO. Bilal, thank you so much for joining us. How much of the sell-off that we're seeing right now is simply a function of the removal, or I guess retracing some of the moves we saw in the past 3 days of the market ahead of the FOMC versus actual fundamental drivers?
I think that's a very good question. I think a large part is this reversal of the market's initial interpretation of the Fed meeting being dovish. I think in the end, if you step back, what the Fed has done is it's raised interest rates by 50 basis points. It started quantitative tightening, QT, which will likely see over $500 billion of the balance sheet be reduced. That's still quite hawkish in the grand scheme of things. It means the Fed is in the middle of a hiking cycle that could go much further than people think. And in the grand scheme of things, that's bad for risk. Yet at the same time, investors constantly want to front run what the Fed is doing. They want to always anticipate the turn down, the dovish turn in the Fed. And what we're seeing is that doesn't work right now.
Does the market, the central banks, have a clue what is happening here and how to react to it? And is this now the new normal? We've been through 10 years of basically QE anesthetizing markets, central banks anesthetizing markets. This is the new normal. Get used to it, folks.
Absolutely. I mean, to be honest, having been in markets for a long time, we never have a clue at any point in time. And when we look back, it seems simple, but at the time, it never was. But you're right. I think what has changed now, for me, the fundamental difference is that since the global financial crisis, we had this QE low rates environment. And people just aren't prepared for interest rates going back to not just the 70s, which is the extreme scenario, but the 2000s. The Fed raised rates to 5.25% in the 2000s. And nobody's expecting that. Even now, the markets are pricing a 3% terminal rate. But if we say, the Fed's going to go to 5%, that's not unreasonable. It's inflation's higher than it was in the 2000s. Unemployment rate is lower. That's perfectly reasonable. Yet that shocks investors. And that tells you how much more pain there is in the market for when we do probably get to those levels.
I've got to ask you about the inflation picture, the currency picture, as well. As we talk about interest rate differentials, we have to look at the dollar, a key stronger dollar move. You've already seen weakness in the pound, in the euro, in the Japanese yen, you name it. To what extent is this dollar strength going to roil some of the other markets?
Yeah, I mean, I think in general, when you do have these bouts of dollar strength, it does destabilize markets. On the one hand, the rationale for the dollar going up is often because the world is not looking good in some ways. The volatility is picking up. So that's part of the reason why a stronger dollar is bad. But also, it also puts pressure on lots of emerging markets and lots of other countries as well. And so then you get this issue around dollar debt dynamics and all of those sorts of things. So generally speaking, dollar strength tends to be a risk aversion type dynamic. So this is certainly not helping markets right now.
Is something going to break?
I think things already have started to break. We're seeing these outsized moves. We've seen a 10 basis point sell-off in bonds just overnight. I mean, that's really quite large. We've had the plunge in the Chinese yuan over the last few weeks, multiple standard deviation moves. So every week there's these extreme market moves.
But is something going to break to the point at which central banks have to do something about it?
That's a good question. At the moment, the main focus of central banks has to be the real economy and inflation and the pain inflation is inflicting on the average person on the street. I think the issue for all of us also to some extent is that we've got so used to central banks caring more about financial markets than the real economy. We're not really appreciating that they need to care more about the real economy, which means that they'll probably end up raising rates more and care less about financial markets. I'd put another way, they'll be much more willing to accept weaker equity and credit markets than we otherwise would think.
I mean, I find it fascinating that guys talking about is something going to break, because I also wonder how much of this is simply going back to normal. If you actually look at valuations, fundamental drivers, a lot of people will say, well, take a look at some of these numbers. They're going back to where we were in 2019 and 2020. But at the start, pre-pandemic, we were talking about these same issues, weren't we? Decelerating growth, a rally really endured, or I should say prolonged, by the Federal Reserve. And of course, valuations even then at extreme highs. Do you think we're just going back to where we were, say, 2-3 years ago?
Yeah, I think we are, and probably more as well, because a lot of the rally we saw in global equities, in particular US stocks, tech stocks in particular, since the global financial crisis onwards, was helped in large part by low interest rates. So low interest rates allowed the rise of tech companies, the rise of all of these venture capital, private markets, and so on. It really sort of fueled all of these moves and made it much, much easier. Now, we got a taste of what happens when the Fed raises rates in 2015, 16, 17, when they hiked rates. Now we're getting another taste of that when they're ratcheting rates at a much higher level. So I think that valuations could compress a lot more than even what we saw before the COVID period.
Do I just sit this one out? Everybody keeps telling me you've got to be invested because you're worried about inflation and your money's going to take a hit because inflation's going up at 7, 8, 9, 10% or whatever. But I'm looking at an equity market and I'm looking at a bond market that is cratering. Do I need to be invested here?
Exactly. I mean, my kind of overall point when I speak to people, investors, and just friends and family is that in this type of environment, cash is king. And the reason for that is even though the money you have in your bank won't earn much interest, at the very least, it's there. It won't collapse in value, unless the bank collapses, of course, which hopefully it won't. But in this environment where so much is changing, it's all about preservation of capital. You just basically don't want to get wiped out. And that's the rule number one for all investors is don't get wiped out. That's the first thing. Then you worry about what returns you can make. And in this environment, things are so unstable that being long bonds, long equities, long whatever is just too difficult to have those positions on in an environment of a switching regime.
Bilal, how much of the sell-off that we've seen year to date, let's forget about today for just a brief moment, but year to date has really been a function of who's actually driving the market? About a year ago, or I should say a little bit of a year ago, we were very concerned about the retail frenzy and there's this new money entering the market and driving these flows. But a lot of the selling year to date has been largely institutional. How do we square who's actually driving some of these trades?
Yeah, that's indeed a very good question. I mean, in the end, it's very hard to determine exactly who the drivers of the flow are. Certainly, data is telling us that that institutionals are selling in this environment, but also there's some evidence of retail as well selling in this environment as well. But overall, the other thing we have to acknowledge is that when you have markets that have very large dislocations and high periods of volatility, small transactions can have an outsized move, outside impact on prices as well. So it's not necessarily you don't necessarily need to see large selling by any particular segment of the market, but it depends on the liquidity in the market and what they're selling into.
Which do you think the market should focus on from the Bank of England today? Its growth outlook or its inflation outlook?
I think it's hard to know when you listen to the Bank of England. One kind of gets dizzy trying to work out what the one should just focus on. I mean, if you step back, what the Bank of England is saying is they're going to reach double-digit inflation by the end of this year. And to put that into context, the US doesn't have double-digit inflation.
Yeah.
Germany doesn't. Europe doesn't. Sweden doesn't. Canada doesn't. The countries that do have double-digit inflation are countries like Romania, Nigeria, Sri Lanka. I mean, we're kind of in that ballpark now. So that's quite worrying. And then at the same time, they're telling us that we're likely to see some kind of recessionary dynamics. This is really 1970s-style stagflationary dynamics. So I think overall, it just tells you, at the very least, the macro picture is terrible in the UK right now. So from a risk perspective, like credit and equities, that's a big sell. But at the same time, if you are going to see 10% inflation, it's going to be very hard for the Bank of England to not hike rates more than what the market's currently pricing. I think that's really the challenge for the market right now. Maybe they're focusing a bit too much on the projected growth slowdown, but the reality is when you hit 10% inflation, you can't have interest rates at 1 or 1.25%.
Yeah, that's quite a negative real rate. Bilal, it's been great to catch up.
Great.
Thank you for your insight. Really appreciate it. Bilal Hafeez of Macro Hive. I spent the whole day focusing on the Bank of England. I'm not sure I'm any the wiser.